Welcome back, everyone. Now, here's a method that we're going to look at that the operations department uses to maintain the right level or the optimal level of inventory as we discussed in the last video. Now, what you see here is a graph, and of course, a graph with two axes. Here we see the stock levels on the y-axis, so a company may have 100 to 400 or beyond that. And on the x-axis, we see time in months. So how this works is that this yellow line here is the inventory level graph. And why this moves down and back up is because every month when a business starts producing, obviously they would have bought the raw material. When they start producing, the level of raw material is going down, and also you're selling your finished goods, so that level of inventory is also going down. So over the month your inventory will start to deplete, and it'll come a point where you know that you have to reorder your raw materials. You go back to a level and then start producing again and again the level of inventory that you need to maintain. Now, you'll remember from the last video that we discussed a situation where a business may find itself having more inventory than it needs, too much inventory. Of course, that comes with more storage cost, cash flow problems, so you don't want to go to that level. And that is the level we see beyond the maximum level here. The blue part here are the problems that you start incurring or you start facing if you have too much inventory. Nobody wants that. Therefore, a business will give itself a cutoff. And that cutoff is called the maximum stock level. This is the level above which the company will never order, because then the storage cost and other problems start incurring. So that's the maximum company is willing to go. In this case, that's 350. Then there's also a situation where you don't want to have less inventory than you need, not enough inventory. And that is this blue part here. Okay? You don't want to go there because loss of sales, loss of reputation, and all that situation. So you want to remain between these two portions here. So you give yourself a maximum and you give yourself a minimum level. Look, we're not going to keep anything less than 150, and we're going to vary between this line. So as you continue to produce and sell over the month, as soon as you hit the minimum level, make sure you order, and you order in time so that your inventory is back up to the level that you want to maintain to continue producing for the rest of the month. Now, the distance between your minimum stock level and zero is called your buffer stock. Some companies will choose to keep some spares. As you'll remember from our first video on inventory, spare parts are also part of your inventory. So some companies will choose to keep some spare parts, and that we call buffer stock. That inventory, should something go wrong, you have some spare parts to fall back on. So you don't want to be above the maximum. You don't want to be below the minimum. Yes, the buffer stock is there, but it's only there for emergency needs. So this is one way that you make sure that you're not incurring too many costs, and yet you still have the right amount of inventory in the business. So things to remember from this: maximum level, minimum level, buffer stock. There's one more concept here that we should discuss, and that is a concept called lead time. Now let's assume we order inventory at this point of a month. So let's say midpoint. 15th January, we order, let's say this is, I should put it here. Let's say this is 15th Jan. And you receive the inventory on 31st. So it takes them the rest of the month to do it. Lead time is the difference between the time you order till the time you receive it. So 16 days here, 16 days is the lead time for any supplier to bring the product to your doorsteps. That's important because you want to make sure that your order arrives in time, not early or late, because if it's early, there's storage cost. If it's late, loss of sales. So you want to make sure you give yourself ample time to receive the order and make sure there are no delays in your own production process. That is lead time. And before we move on further, I want to point out one thing here, that there is a big limitation of this process here of the stock control chart. And that limitation is that this process assumes that all of your inventory will be ordered and sold and made in the same proportion every month. So it shows a very linear relationship that every month you order the same amount because you're consuming the same amount and the same process go up and down. And we know that's not the same. Some months you will have a higher sales volume, some months lower volume. So in some months you may still be left with some of your inventory and you may need to order later. And some months you may lose your inventory quicker and you may need to order quicker. So you order different levels depending on the current situation. And this process assumes that that's going to be a repeatable pattern, the same levels of sales and reordering of raw materials. So we have to use this method with a little bit of caution that things will be different, but at least it gives us some way to measure and gauge the right level of inventory that we need to maintain to avoid any extra costs that come with it. Now, in total, there are 5 important topics to take away from this. I'm just going to list them here on the next slide for you to remember them. So the first of these is your maximum stock level, the most stock that a firm is willing to hold, above which you start incurring more storage costs. The second one was your minimum stock level, that level at which a new order must be sent and received so that your own production does not get halted. Then we looked at buffer stock, stock in reserve in case of any delays or any wastage. We looked at lead time, the time taken between ordering and receiving your stock. And there's one more here called reorder quantity. This is the amount of units that you order when it's time to order. So as soon as you hit the minimum, you got to go up to your maximum level. So the distance between the maximum and minimum levels is known as reorder quantity. Okay. Now, a question on this may appear on your paper 2. As part B1, where they ask you to calculate a few things, they may show you a graph and they ask you to calculate certain points on it. So I'm going to show you an example of how that calculation is done. So here is a question from 2017, November, paper 21. This is from the first case study, and we're attempting B part 1. And we see something familiar here. This is a stock control or inventory control chart for that business. And we can see here that they're at level 60 here, and the stock chart is going up and down as we've seen previously. You're given time, inventory levels, and you're asked to calculate 3 things. Firstly, your maximum inventory level, then your buffer inventory level, and then finally reorder quantity. So we know that the maximum level is that level above which the business's graph will never go, and we can see that here to be at 60,000, right? So your maximum level is 60,000. Buffer inventory is the distance between 0 and your minimum level. So this portion here between 0 and 10, highlighted in blue, is your buffer stock or buffer inventory. So your answer to this would be 10,000. This is the extra cushion a company will give itself in case something goes wrong. Now finally, reorder quantity. This is the distance between maximum and minimum level. And the way to remember this is that whenever they ask you about quantity, it's always vertical. Whenever they ask you about levels, it's always horizontal. So you see vertically the distance between maximum and minimum. So when we reorder at 10, how much do we end up having? We end up having 60. So the distance or the amount that you're ordering is 50,000 units to go from 10 to 60,000. Reorder quantity. That's how you may be tested. This is how you attempt it. And that is your stock control charts.